Hello friends, I welcome you in my another video. This is part 3 and today's topic is performance indicators of the bank. Okay, so in this video we are going to discuss about the return on equity, return on assets and yield on advances. So let us start with return on net worth or equity. So what is the return on net worth or equity? This is net profit, that is your profit after tax. Okay, PAT multiplied by 100 and divided by the net worth. But while taking the net worth, we will exclude the revaluation reserve, foreign currency translation reserve, deferred tax assets, amalgamation reserve, and provision for unamortized pension liability, etc. Okay, so this is the formula of return on net worth. Okay, so every investor is curious to know that the money invested in him is getting the right profitable path and how much return the investor getting from the company. Okay, so here we are talking about from the perspective of the bank. Okay, so this is nothing but the return on the investment made by the shareholders. Okay, so because the share capital and the net worth is purely belong to the shareholder. Okay, so this is from the perspective of shareholder, how much the company or the bank is earning the return. Okay, so in ROE, if the value of equity goes down, the rate of ROE goes up. Okay, so definitely. So suppose, for example, there is a 100 crore net worth, and the bank is earning 5 crore of net profit. It means it is earning 5% ROE or return on net worth. However, if we bring down the net worth, that is say around 90, then definitely your ROE will go up. Okay, so definitely the investor wants the higher return on the equity or the net worth. The company with high return on equity is capable of generating good profit. So this is very important indicators, key indicators for the performance of the bank. And this is, this is expectation from the shareholder that the bank uh, earn a good amount of return for their capital invested in the bank. The next ratio is return on asset. So the formula is net profit, that is profit after tax divided by total assets into 100. Okay, it indicates the capability of the management to generate the return on the total assets invested in the business. If total assets remain the same, higher ROA indicates better management and better deployment of fund. Okay, friends. So return on equity and return on assets are two important parameters or financial indicators for a bank. In case of return on equity, we consider net worth and that is equity. But in case of return on asset, we consider the total asset. Okay, but total assets. When we talk about total asset, it means the total of assets at the balance sheet date. However, okay, but to have a better picture or to have a conservative picture for the performance of the bank, there is another way to consider the average asset. Okay, instead of the total asset, we can consider the average asset, which gives us a better picture of the business. Okay, so what is the average asset? This is average assets equal to fortnightly or daily average of the total assets. Okay, so friend, the average assets are submitted by the banks to RBI in the form of form 10. Okay, so if we consider the average asset, it will give a more realistic picture for the performance, because a balance sheet date, it can be during the year, the performance of average assets may not be that much good, or the total at the end of the balance sheet. So definitely it's a good idea to take average assets instead of total asset. Then yield on advances. So this is nothing but how much is the earning for a average balances of advances. Okay, so the formula is interest earned on advances multiplied by 100 divided by the average advances. So interest earned is basically nothing but the total amount of interest which the bank has earned on the loans and advances. It also includes the interest on investment. Okay, the average advances is equal to fortnightly or daily average of total advances. It is an indicator of effective deployment of fund. Okay, friend, let us understand. This is a very important financial indicator. So suppose the bank deals in different segment of loans. Suppose there is a housing loan, there is a personal loan, there is a commercial loan, business loan. Okay, so suppose if they create different bucket, and if they calculate yield on advances for all different bucket, then the yield on advances gives a better picture, or it helps the management to focus on high yield generating advances. Okay, so this is another very important aspect of this yield on advances. And so suppose if I compare the yield on advances between two banks, so definitely a bank which is getting more yield on advances, it is considered to be in better position. Now let us have a look on the balance sheet. So first we have talked about the return on equity. So your equity is nothing but your capital and reserve and surplus. And return is your net profit for the year. Okay, so this is the for first return on equity. Okay, now for the second return on asset, it means the same thing, the profit after tax divided by the total assets. So here we will take the total assets. But as I mentioned in my slide, that instead of taking the total asset of the balance sheet date, we will take the average asset, okay, based on the return submitted by the bank to RBI. So this will give more, more clear picture or better picture for the performance of the bank. And we have talked about the yield on advances. So yield on advances, if I simply want to calculate, I will take this figure, this advances, average advances. Okay. So again, this is a balance sheet, but I'll take the average advance figure. Okay. And the yield, for the yield, we will take the figure of interest income. Okay, so by applying these two figure, we can get the yield on advances. So with this, I conclude my presentation. Thank you very much. Hope this will add some value in your knowledge. If you like, please share, and if you have any doubt, please write in the comment box. Thank you.